Good morning and welcome this morning to Trading Index Options, another great webcast from Schwab Coaching. My name is Ben Watson. I'm an education coach and senior manager here at Charles Schwab. I'm joined out there in the chat by my good friend Cameron May, who's going to be helping out with answering your questions. Thanks to all of you for being here, whether you're here in the live version or in the recorded version. We appreciate you being here. Participate in the conversation. Of course, that's the reason why Cameron's there. He's going to be helping out answering those questions along the way. And gosh, it's nice to see some of those familiar faces and names here in the chat. So thanks for being here, Janelle and everybody else. I appreciate you all always being here. And if you're brand new, welcome to you as well. We're going to get into this discussion here pretty quickly. A couple of quick housekeeping items, though. Really, we're going to take advantage of the fact that the market has been kind of moving a little bit more perhaps than it has been in the last couple of weeks. That gives us some opportunities. You know, one of the things that I say on a fairly regular basis is that volatility brings opportunity. Now, we don't have a lot of volatility, but there's still potentially some opportunity out there because of that price movement. So let's take a look at that as we get into this discussion. But a couple of quick housekeeping items. Remember that everything we talk about is simply for illustrative and educational purposes only, not a recommendation. Remember that investing involves risk, including the loss of principal. Remember that past performance, no guarantee of future results. Now, trading equity and index options, that carries a high level of risk. It's not suitable for all investors. Make sure that you are aware of the characteristics and risks of standardized options before considering any option transaction. Remember that there are some differences between equity options and index options. We'll talk about those along the way. One of those differences is simply that European style index options, which most of them are, not all of them, but European style index options cannot be exercised early, which means it removes early assignment risk. For some traders, that is one of the attractions to index options. We'll talk about that as we get into this discussion. But remember, if you're short an American style option, it's always a good reminder that that can be assigned at any time up to expiration, regardless of where it is, in the money, at the money, out of the money. It doesn't matter. Now, we're going to use technical analysis. Technical analysis is not the only way to evaluate the market. It is theoretical in nature. It's not guaranteed. And Schwab doesn't recommend the use of technical analysis as a sole means of investment research. Again, that quick reminder that stop orders do not guarantee a fill price, even in index options. We're going to talk about why not to use a stop order in trading options. And remember that we're going to be using the Thinkorswim desktop software platform today. It is a great learning environment, especially the paper money version of that platform. However, it's not a guarantee of future success out there in the real world, and it doesn't do some things in live trading that it does in paper money that it does in live trading. So be aware of some of those differences as you switch your practice from paper money to live trading. Just be aware of those differences along the way. So let's do this. We've talked a little bit. I'm going to pop over to the Thinkorswim platform here. We've talked a little bit about volatility. We've talked a little bit about market movement. And we've certainly seen some market movement in the last couple of days. This is the S&P 500 making a big move to the upside yesterday, and really continuing a little bit of that today. So Friday, we saw kind of this big, if you will, bullish engulfing candle. Monday, we saw that big bullish engulfing candle. I have to remember which day we're on. Yesterday, we saw the gap up and the rally. And now today we're seeing maybe a little bit of a deliberation type of candle. Nevertheless, a little bit of movement. And we're running back up against some of these previous highs in the index. Now, that would suggest that maybe there is a bit of deliberation at this point. That's the name for the candle, is a deliberation candle, kind of a wait and see mode, if you will, up against these resistance levels. The question is this profit taking? Is this just waiting for the next shoe to fall? Is this waiting for news, or is this being influenced by this being really kind of the big breadth of that move? And now buyers are looking for a pullback to re-enter or to add to positions. All of those, or none of those, could be the cause. Let's take a look at the NASDAQ here, because we're seeing something very similar, although we're seeing a little bit of a move today above those previous all-time highs in the NASDAQ. So some strong moves to the upside here in this particular case, a little bit more of a gap up and a bit of a sell-off, perhaps into a little bit, if we zoom in, a little bit of a shooting star, although shooting star type candle would typically tend to see a little bit longer move to the upside and then pulling back a little bit. As a matter of fact, I know Cameron has taught in a couple of his getting started with technical analysis webcasts from a little while ago, talked about specifically that type of candle, that shooting star type of candle and what it imports. But you're also seeing in this move some moves back to the upside in terms of RSI, that relative strength index. So gaining some momentum to the upside. This pullback today in this candle could be the only pullback that we see back into these support levels, and then again a continuation of the rally. So that's something to pay attention to as well. And the last one that we'll look at here is the Russell 2000. And again, the Russell 2000 is one we've talked about quite a bit. We've used this as a tool for hedging, at least the options on the Russell 2000. We've used that as a tool for hedging the performance of our portfolio. But this is a little bit different. This is kind of one of these things is not like the other. One of these things just isn't the same type of perspectives. Because on both the NASDAQ and the S&P 500, we saw breaks above the 200-period moving average. We saw breakouts above previous resistance levels, significant previous resistance levels. And in this particular case, we're seeing really more of that sideways movement on the small caps. So my thought was, sideways movement is still movement. That still presents us with an opportunity. And that opportunity, with implied volatility being relatively low, is something that we might think about. Would be possibly, with low implied volatility, with the possibility of it rising, would be potentially a long iron condor. And let's see what that looks like here in this particular case for this scenario. Now, generally, when we think about long iron condors or long vertical spreads, we've got to see, in order to get to maximum theoretical gain, we've got to see movement of the underlying security into both of the legs of the spread, meaning both of the legs of the spread on a long vertical, say for instance, or a long iron condor, both of the legs of that vertical getting into that range of being in the money, and or seeing early assignment with short index options. We don't have that possibility of early assignment. So a long vertical spread or a long iron condor that requires, in order to get the maximum theoretical gain, a move into the spread and then early assignment, bringing that theoretical maximum gain, may require more patience. So I'm just going to say that at the outset. A trade that we put on, as we put this trade together here, or this idea together, may require a little bit more patience and may require holding the trade through until expiration, or at least one side of the trade through until expiration. So let's see if we can look at how this might come about, how we might put this trade together. It may very well end up being a butterfly spread, to Harry's point, a long butterfly spread, but we'll see how we'll put this long iron condor together in this context. And in that particular case, we might be looking for movement outside of a particular range, right? Because a long vertical spread, which are the two components of that long iron condor, require some movement of the price of the stock one direction or the other. And we'll see how that looks on the risk profile graph. But that kind of gives us a sense of what's going on at the indexes. Let's also take a look really quickly here at our VIX grid, just to kind of see where volatility is. And we can see the volatility has been collapsing back down into that. We're now down into the 17 handle. We were at about the 18 handle yesterday, which is quite significantly lower, at least from a relative perspective, than where we were a week ago at about the 21 handle. That's going to do a couple of things. One, it's going to bring premiums down. Two, there is that element of when implied volatility is low, implied volatility tends to rise. So we might even be seeing that a little bit here. But we're seeing kind of that reconnection of that opposite movement or that inverse movement, right? So see, yeah, that again would be the benefit potentially of doing a long iron condor in this particular case and putting that type of trade together on this on an index option. So let's do kind of first things first here, though. Let's go back to our index grid really quickly. And let's go back to the SPX, and we can see what's going on with the SPX. We can see that we saw a big move to the upside since last week, pulling back just a little bit. So I'm going to go to the monitor tab, and we're going to go to our 14-day 14 days till expiration, 7 days till expiration index option spread. So to Kenneth's point, and Kenneth asks a great point, says expecting a session to explain the basics of trading index options. And we do have that. So let me show you really quickly where we're going to find that information, because I want to address this and make sure, because I know that there are people who are here for the very first time, and we appreciate that. We know that there are those of you who have been here for a while, and we've established an understanding. But what I'm going to do is I'm going to pop right back over here to our Trader Talks webcast channel. By the way, this is a great place to click on subscribe, because then you can set alerts for new content. But I'm going to click on this little search icon, index options. And we've got an entire playlist of index options, right? So here is a great one that we did earlier this week, right? Earlier this week, intro to index options, right? Trading index options, hedging with index options, exploring the world of index options. So we've got lots and lots of resources to be able to establish kind of that basic understanding of index options. So there's the great way for you to kind of catch up on using index options. So thanks, Cameron, for doing that. Let's pop back over here to the Thinkorswim platform, because here's where exactly we were going. This 14-day, 7-day to 14-day, 7-day short vertical spread. So last week, we sold the 57.80, 57.60 short vertical spread on the SPX. These were puts because we were above the 200 period moving average. So we're selling put spreads. We sold it for $1.90. It's now trading for 22 cents. That's done the majority of the work that it can do for us. It's now trading for 20 cents. So we're going to first close this one down, right? So we're going to create a closing order to buy this vertical spread back for 20 cents. We're going to close it down. And now we've taken that trade off. It's done the majority of the work that it can do for us. The reason that we do 14 to 7, we close it down at 7, come what may, is because, number one, the majority of our time decay in this trade, because it's far out of the money, happens in the first week. Number two, letting this stay for another week to go until expiration, in this particular case, is only going to net us another 20 cents. So it doesn't make sense to hold on to that obligation or that risk potential to take a maximum theoretical loss for another week for the sake of 20 cents. That's the reason for taking it off at 7 days, or one of the reasons for taking this trade off at 7 days. So I'm going to go ahead and click on confirm and send. We're going to read through the order, make sure that we're aware of that order. We're going to put it back in that index options weekly group. And I'm going to go ahead and click on send, and we're going to fire that off. And we bought it back for 20 cents. So we got the majority of the work that we could out of this trade. We got $1.70 out of the trade, and we sacrificed 20 cents for the sake of this last week of time in the trade. So now what we're going to do is we're going to continue this process. Now, we could have done this all in one, but I do this separately just so that we can see the process clearly again and again and again, right? So here's what we're going to do. We're going to go to the charts. I'm going to change my grid to my index options grid for the SPX. And all this index options grid, by the way, this grid link is in the description page for this webcast. So all this index options grid is on the left-hand side, a 1-year daily chart with a momentum indicator and the 200 period moving average. That's our toggle. If the SPX is above the 200 period moving average, we're selling put spreads. If it's below the 200 period moving average, we are selling call spreads. We're still above the 200 period moving average, so we're still selling put spreads. The right-hand side is a 3-month daily chart, so we get a little bit of a zoomed-in view, and then I've got a probability of expiring cone, and I've got an implied volatility chart. So implied volatility has come back in, and because implied volatility has come back in, it is dropped very likely the amount of premium that we're likely to get in selling this vertical spread. We're also going to be likely selling closer to where the at-the-money strike price is. So I'm going to take this line, I'm going to delete that line, that's my time hack, and we know that if we go to our trade tab, 14 days to go until expiration right now is on the 9th of July, okay? So we're going to go back to the chart, we're going to use our time level, and we're going to put a time hack on the 14th, or on, excuse me, on the 9th of July. That's right here. Whoops. Set it right there. There's our time hack. That's the 9th of July. So we're selling put spreads, so we're going to be selling on the bottom edge of this curve. And I'm going to be drawing a line at that intersection. So that's right about the 5,900. And you can see, so I've left these on here week after week. And you can see where we've been selling these vertical spreads. We were selling down here, down here, down here, down here, down here, down here. And you can see that as volatility has decreased, what's happened with where we've sold these vertical spreads? It started to get closer to where the price of the stock is. So yes, there's been movement on the index, but I think this is kind of an interesting study to see the effect of higher implied volatility versus lower implied volatility on where a 1 standard deviation strike price likely falls. It's going to bring that range in. So that's where we are now. I'm going to take this line off just to avoid confusion. Okay. And here's where that level is, 5,900 strike. So we're going to go out to the trade tab. And I'm probably going to have to do more than 50 strikes. So I'm going to have to go to about 100 strikes, is just probably just from experience here. And I'm going to scroll down. Here's our 5,900 strike, right? It's about the 15-cent delta. So it's a little bit further out in this case. So bringing in 1620, and we're going to go 20 points wide. We've been going 20 points wide simply as a matter of giving us enough premium to make it worthwhile. So we're going to sell the 5,900 and we're going to buy the 5880. That's 20 points wide. Okay. We're getting $1.80, 10 cents less than we got last week. Okay. 10 cents less than we got. Now it's kind of bumping around a little bit. Okay. So the thought is that yes, this is a small credit, right? We click on confirm and send. We see what our maximum theoretical loss is. But we've talked about this before, right? We've talked about the concept of this before. This 5,900 strike that we're selling in this particular case is at the 15-cent delta, which is about a 15% probability of being in the money at expiration, okay? Which means that it's about an 85% probability of being out of the money at expiration. But human nature is that we underweight those high probabilities. We tend to underestimate the likelihood of that high probability scenario happening. We tend to overestimate the probability of a low, or the likelihood of a low probability scenario happening. So we're going to argue in this particular case that there's a low probability that we're going to take our maximum theoretical loss. Now, I've said that before, and news has happened And we've taken our max theoretical loss. So don't be lulled into a false sense of security in that you can't take a maximum theoretical loss just because you're selling at the 15 delta at an 85% probability of being out of the money at expiration, because it can happen. We've seen it happen. So it is something, however, that we need to take into account. So we're willing to take a little bit higher theoretical maximum loss by widening that out to a 20-point wide spread to make it a little more efficient in terms of bringing in premium. But the likelihood is that we're going to get some portion of this maximum theoretical gain, the $1.90. Unless there's news, which there's always news. So I'm going to go ahead and I'm going to click on confirm and send. We're going to roll this order off here and make sure that we're aware of any alerts that might be present. I'm going to go ahead and I'm going to put this in my index options weekly group because that's what we've been using to track this. Max theoretical loss, again, still is $1,820. So if that does not fit with the size of your portfolio or your risk tolerance, then adjust the spread or use a different instrument, right? And so we're going to go ahead and we're going to click on send. We're going to fire this order off. And we sold it for $1.80. So we got $1.80 for it. Now what we're going to do is we're going to take this trade off at 7 days to go until expiration. Come what may, right? Come what may. And you're right, Hallie. It depends on the severity of the news. Sometimes, look, so in that scenario, when we get news, we've done this trade when just literally hours after we put the trade on, there was market moving news. I said one day, the only way that we get hit with this is if there's a rip your face off rally. Literally that afternoon, there was a rip your face off rally, and we ended up taking maximum theoretical loss. Now, Ellie asked a great question. When that max loss occurs, is there a strategy we can implement afterwards to recover? Now, that would then imply that we would manage or adjust or fix the trade. And I don't like that idea. I want to be willing and comfortable with taking that maximum theoretical loss in the trade and simply moving on. Now, yes, there are ways you can do that, but traders may oftentimes run into a scenario where they're putting good money after bad. If the trade's gone wrong, simply take the trade off, close it down, take the loss, and move off. Again, human nature is, though, we are loss averse. We tend not to want to take those losses because it psychologically then brands us as a loser, right? So anyway, we don't want to be branded that way. Anyway, that being said, this is the trade that we're going to look at. It's already moving against us just a little bit, but again, that's that market move, right? But the expectation is we're going to take the most of the majority of that theoretical gain in the first week because of that acceleration of time decay. All right, now let's look at a couple of other spreads here real quick as we manage this. We've got one that we put on a couple of weeks ago on the Swiss franc index. And I also talked a little bit about this yesterday in the futures webcast, XDS, which is the Swiss franc index. We talked a little bit about the fact that when there is time of geopolitical uncertainty, the Swiss franc tends to be bullish, simply because it tends to be kind of that perceived psychological safe haven. We've seen that happen. We saw a big move to the downside on one candle, kind of a big adjustment to the downside, and then it started to rally back a little bit. This right here, this candlestick right there, that long lower shadow on that candle is the reason why we don't put stop losses typically on option trades. Because at some point during the context of that candle, if we had put a stop loss on this option trade, it's very likely that that option would have been kicked out of the stop. But what's gone on to happen is that with that volatility, we've now seen the price of the index continue to rise. So one of the things that maybe we do with trading options is be willing to accept the maximum theoretical loss in the trade, or put an alert on, as opposed perhaps to putting a stop to manage the risk in the trade. The risk in this trade is what we paid for it, which was $3.55 per share, right? Because we're long a call. So now that this is running in that particular direction, it's starting to move in the direction that we want it to move, starting to move bullishly. One of the things that we could look at doing would be selling a call against this to help kind of create maybe a little bit of diagonalization, bring in a little bit more premium and offset the cost of that trade. So we could leg into this diagonal in this particular case. So what I'm going to do is I'm going to go back to that trade tab, and I'm going to say, look, here on XDS, whoops, we're on SPX here. Let's go back to XDS. There it is right there. We don't have the ability to diagonalize it, but we could sell an option against that long position since it's now deep in the money. It would be the equivalent roughly of creating now a long vertical spread when we've gained some equity in that long option. So if our expectation was, looking at the chart for XDS, that maybe we run into this resistance level here at 124, maybe we could sell the 126 or maybe even out to the 127 or 128 strike price, bring in a little bit of premium and offset again that that cost of the long option. So I'm going to do this, and we're going to roll this into a long vertical spread because we're running back up into that resistance level. Now, if it goes up through this long vertical spread, I've capped my potential gain in the trade. But I'm okay with that because we really don't have, I mean, this is already deep in the money, right? So the rate at which this is accelerating in terms of gain is slowing a little bit, right? Because we're pretty close. We're at an 89 delta. We're at almost a 90 delta. The most that delta could be would be $1, right? Would be a delta of 1. So the deeper in the money this goes, the less leverage it has, basically, in terms of the less efficient it is at generating deltas. So by offsetting that a little bit, by selling some premium, bringing in a little bit of premium, we're augmenting this long option, but we're also defining our maximum theoretical gain in the trade if this index goes up to 127. So I'm going to go to this one right here. I've got actually the 126 has a little bit tighter bid-ask spread. So does the 128. I'm going to go to the 128. We're going to sell that for about probably 70 cents. And we'll see what we can get out of it if it goes to the midpoint. We're going to sell this against that long option. So we're essentially now creating a long vertical spread. Now, Frankie says, why not sell an earlier expiration? Because we don't. We don't have one. This is the most recent expiration, right? Now, we could roll the long call down too, Greg. You're absolutely right. And that would give us additional leverage. And so that's something that we could certainly look at doing as well. But I'm going to go ahead and do this really quickly here now for the sake of simplicity because I want to demonstrate this. I'm kind of lining this up to use for something in the coming weeks as well. But yeah, that's absolutely a possibility. So I'm going to go ahead and click on send. We're going to fire that order off. And we'll see if that gets filled and helps us to create that long vertical spread. All right? Okay. Yeah, notice we don't have any earlier expiration dates here. All right, so now let's go back to the topic that we were discussing at the very beginning, right? Let's go back to our charts. Let's take a look at RUT, the Russell, and kind of moving in that sideways direction. So we were going to talk about doing a long vertical spread or a long iron condor here in this particular case, meaning we want to see directional movement, but we want to we want to see that directional movement outside of the range. When we create a short iron condor, right? When we sell a vertical spread, let me grab my magic marker. Short iron condor, we're pretty used to, right? We're creating a vertical spread, short vertical spread above and below, and we expect the price to stay within this range. A long iron condor, right? The long iron condor does almost exactly the opposite, right? We create a long vertical spread. So let me grab my magic marker here. We create a long vertical spread here. We create a long vertical spread here, and we expect price movement one way or the other outside of that range. Okay, outside of that range. It is a spread, a long iron condor spread that requires some movement. And I'll show you what this looks like. So let's do this. I'm going to create, first of all, a short iron condor, because I think we're familiar with that, right? Generally. So let's go to the trade tab. And let's go to RUT. And we're going to do this out. I'm going to do this out to, say, for instance, we'll do this to the regular. Actually, let's go out to the 18th of July. Let's give it a little bit of duration here in this particular case. And let's see what our volume and open interest looks like. Now, somebody had asked the question about volume and open interest on those currency indexes. And sometimes those currency indexes can be a little bit illiquid. This one is a little bit illiquid as well. Let's go to the 11 July expiration. Let's do 25, 31 July. Let's go to this one. This is the end of month. That's probably got some volume and open interest here. And I'm not seeing volume on this, but we are seeing some strikes with some pretty decent open interest. Okay. Yes, generally, see, if you think about it in terms of that question, right, you can make the distance between the two sides shorter. So let's do this. I'm going to take this back to delta, gamma, theta, vega. Actually, I'm just going to take it back to, let's do this. I'm going to create a custom set because I'm going to take gamma out of there in this particular case. And we'll save that as delta, theta, vega. Now we've got delta, theta, vega. Okay. So normally when we were creating an iron condor, what we would do is we would come in here, we would find a strike that we expected the price of the stock to stay above, and we would sell that side. Whoops. 2080, let's create a short put vertical spread first. So 2080. Let's sell the 2080, delete that, sell the 2080, and buy the 2070. We'll just keep it 10 points wide. Okay, there's our short put vertical, right? Expecting that the price of the stock is going to stay above our short leg, 2080, the price of the index in this particular case. And then what we would do is we would come over here to the other side and we'd say, all right, where are we? We're right about the 30-cent delta. Let's sell the 2220 and buy the 2230. That's creating a short iron condor, right? And if we right click and we go to analyze trade, we look at that iron condor and we can see where that, let me kind of spread this out so that we can kind of see what that looks like, right? So here's our short iron condor. Let me come back a little bit so that we get, there we go. There's our short iron condor. That expects that the price of the stock or the price of this index is going to stay within this range. But what if we wanted to have the price of the index move outside of that range? So this is, remember, going to be bringing in a credit of $5.45, against which, if we confirm and send, we've got a max profit of that $5.45 times 100 shares, or we've got a max loss of $4.55. So remember, the iron condor is a defined gain, defined risk trade. If we were to change this, so what I'm going to do is I'm going to change the side here to buy, and we're going to create a long iron condor. Same kind of structure, same strike prices, right? We just turned this into a buy. So now we're buying those short legs and selling the ones that we were long. We're creating this order for a $5.45 net debit. So it's going to be money out of pocket. But if we go right click and we go confirm and send, now we see that that max profit, max loss has flip-flopped. It's changed sides. So now we're creating a long iron condor, right? Where the drivers become the long legs of the trade. We want to see price movement outside of that range that we've defined, so that, you're right, to see us point, that allows us maybe to bring those ranges together. Now, bringing those ranges together, if we were to adjust this in a little bit, let's see what happens to this trade if we were to bring those legs a little bit closer, okay? So what do we expect the price of the stock to do? Here's our short leg, right? We want this index, ideally, at expiration to be outside of this range, right? Outside either below 2065 or above 2230. What's our short leg? 2230, right? Those are our short leg, or in this case, short legs, right? So we want it to be above those ranges, right? So what if we were to bring this in a little bit closer? The challenge with bringing this in a little bit closer, if we were to bring this in a little bit, is we're going to make this spread more expensive, but it's going to require a smaller move to get outside the range, right? But if we make that a wider long iron condor, right? If we expand that range, then the price of the index has to move more in order for us to get to our maximum gain, right? Okay, so that's the trade-off in putting this trade together. But what I'm going to do is I'm going to put this trade together. Our expectation is in a long iron condor, okay, where the long legs are here and our short legs are here, we're expecting movement either this way or this way, right? If we were making this a short iron condor, like we did to start, to create this trade to begin with, the short iron condor, if we just turn this around again, like we did before, that short iron condor expects that the price of the stock is going to stay within this middle range. But making this a long iron condor, we've changed our expectation. Our expectation is for price movement. So we go back to the chart, and we see that if we go back to the first one here, our index grid, and we look at the NDX, or excuse me, the Russell 2000, what do we see going on? Remember we talked about this, that the price of this index is kind of waffling around in this range. And it's been waffling around in this range for a while. Could it still do that? Yes. So if we expected there was going to be a catalyst, let's say, for instance, the July Fed meeting that might push the NDX or the Russell 2000 because of interest rates, might push the Russell 2000 outside of this range that it's been stuck in, then that might be a scenario where we would expect a long iron condor to benefit. Now, the other thing is, this long iron condor, if we go back to the Analyze tab and we open up our price slices here, let me open that up. If we open up our slices in our long iron condor, let's make this our at-the-money strike. There's our at-the-money strike. This is relatively, at least from this standpoint, delta neutral, right? It works against us if time passes. But remember that if we're going to sell this back, we're not going to benefit from early assignment. So this rate of theta decay is not huge. But notice the Vega. If implied volatility goes up, if implied volatility rises, that's definitely going to benefit this trade. Okay, so we're going to fire this order off. I'm going to pop this up from the bottom. That's where I had it. Oh, we need to switch it right here. Buy $5.50. We're going to go ahead and we're going to put this in our index options group right here. And $4.50 is our max theoretical gain in the trade. Price has to move up or down. And our max loss is the cost of the trade, as it is in any long option or long spread. So I'm going to go ahead and I'm going to click on send. We're going to fire this order off. And now we got that for $5.45. Ideally, we want this to get more expensive, right? We want this to get more expensive. So we've talked about long iron condors here. We're going to do more with this, but I wanted to use this as kind of a setup for future discussions as we start to see these indexes maybe stay range bound or move outside of that range bound range area. So the thought being in this particular case that if we're creating an expectation, there should be a catalyst. We know that next month, before the expiration of this long iron condor, we're going to have a Fed meeting. And that Fed meeting is likely, that's where there is some expectation of a change in interest rates. A change in interest rates is likely to impact the Russell 2000, the small cap index, and therefore may look at potentially moving this index outside of that range. Now, one last thing I wanted to take care of here is we have a previous spread on the Russell 2000. Actually, we had a previous spread on the Russell 2000. It expires, in fact, today. And it is a 5 days from now. It is a long option. We paid $33.75 for it. It is now trading for 85 cents. It was a long put option that we used as a means to hedge our long stock portfolio that was mostly sensitive to changes in the Russell 2000. So we've had that on for a while. It's now down to 5 days to go until expiration. We bought it originally for $33.75. It's now trading for 85 cents. It's done. We've wrung just about as much as we can get out of this. However, it still has value because it still, over the course of the next 5 days, gives us some protection against movement if we were to sell an option against it. So we're going to do that really quickly here. We're going to go back to that expiration. Here's our long put option. It is far out of the money. If we were to sell a put option, now what we're doing is, again, remember, we're bringing in a little bit of premium against this long put option, right? So if we were to go to an area that is, again, kind of that same 15-cent delta, we could bring in a little bit more premium, the 2090. Now, we're kind of betting against ourselves here, right? Because we've got that long iron condor. We're expecting a big move to the upside or a big move to the downside at some point. But this has 5 days left. So I'm going to sell this. And what we've continued to do is diagonalize this. Now we're in this kind of last expiration. So rather than diagonalizing it, I'm going to turn it into a vertical spread, a long put vertical spread, by selling the 2090, bringing in $3.90 a premium. We're going to put it back in this grid on the index options grid, click on send and fire that order off. Now we brought in 405 because we got a happy little bounce here in between that range. And we go back to the monitor tab and we're bringing in 405 against an option that's now trading at 85 cents. Still gives us the protection in the trade. So it's done a lot of work for us. But this is going to be the expectation here that we're going to close this trade down at the end of this range, or it's going to go out worthless. We're going to let it go out worthless. But we're going to get to the point where we're going to close this down. Theoretically, this will get cheaper. This one will stay about the same because it's probably not losing value very much until we get right to the end of its lifespan. So we've done a number of things today. Again, I know some of you are brand new with this, but I'm going to reiterate this. If you want to learn more, come back over here to our YouTube page, youtube.com/Trader Talks Webcasts. Click on the subscribe button and then click here on the search box to search for the content that you want to kind of get caught up. My thanks to Cameron May for helping out. My thanks to all of you for being active and asking questions, and to our great production staff for helping out today, and our great reviewers. Thanks again, everybody. We will see you next Wednesday. I won't, but I think Brent Moores is taking this for me next Wednesday. We will see you again very soon. Take care, everybody. Bye-bye.